The part of the question that I wanted to ask Rajiv, I'll ask Mayuresh Joshi about it. Mayuresh, we've discussed the telecom piece at length. Just one quick fundamental question to you as a follow-up, because you would have heard this conversation with Rajiv as well. If they go ahead and increase these tariffs, would they risk losing some subscribers to Jio, both Vodafone and Bharti?
Morning, Neeraj. I think that might remain a possibility, and it depends upon the quantum of the hike that they take. The second element, as Rajiv was also mentioning, is the overall base itself. So they've got almost 280 million odd subscribers. The 4G base, they've increased by around 7.9, the quarter gone by 103 odd million. So I think they need to increase this base itself on the 4G part, and the capex thereof also is going to entail that tariff hikes are mandated in the scenario that they are, and also the AGR related risks in terms of the reported numbers and the cash flows, which will remain extremely weak. So there is a high probability that with the hikes, and if Jio probably does not go in for further hikes, some part of the migration might happen to the Jio base. But that probably needs to be seen in terms of the quantum of the hike, that's one. And the second element in terms of the overall relief package that the government probably gives, and the try and regulations as well in terms of base pricing. So I think there are a lot of moving parts here, but the stock probably has, Rajiv was mentioning, has priced in most of the positives that would probably come through over the next few months, assuming these things working in favor of the company itself.
Yep. Okay, so that's as far as telcos go. Mayuresh, just one quick word on Tata Steel and the announcement that has come in as well. Do you think it's a net positive? Some of it was probably priced in yesterday. And on back of that, would you be bullish on the stock?
Yeah, so I think a large part in terms of the price action on the stock itself gestated what news item probably came through. But again, if you probably look at the numbers, Neeraj, and then the scenario that we are probably in, I think the demand-supply dynamics clearly not in favor of ferrous companies at this point of time. Whether you call it pricing on the HRC part, the CRC part, pricing really has got impacted big time. Demand-supply dynamics are key variable out here in terms of how the pricing will move, but that does not seem to be the case in terms of a weak global setup. The third element obviously is that these companies are going to benefit in Q3 because iron ore and coking coal prices have come off. So from an input cost perspective, there are benefits that are probably seen in Q3. But weak demand, weak realizations, and the expectations to probably keep on pushing on volumes, I think that probably takes a hit in terms of operating leverage. So I'll still bide my time for Tata Steel or the other steel companies as well.
Mayuresh, just come in on the aviation as a pocket, and while we're looking at an improvement in the passenger air traffic growth numbers, overall, what's the sense here? Two big players out here that we're going to be watching out for, operationally as well for Indigo and for Spice. Which one do you think is a better option if you had to invest in aviation?
So morning, Devinanda. So again, I think if you probably look at how the numbers have stacked up for the quarter gone by, if you probably look at their average realizations and you probably look into their cost factor, and if you probably exclude fuel out of that, I think fuel was the biggest culprit this time round. And you do a YOY comparison on the Q2 numbers itself, I think crude close to $72 odd with the rupee around 70, 72 as well. So I think the worser impact was probably felt in the same quarter last year. But what they probably got hit this quarter was competition intensity and pricing intensity. So I think the negative yields probably still got played out, because if you start including the fuel aspect in the CASK as well, I think the revenue per available seat kilometer and the cost per available seat kilometer, I think the dynamics were still not matching up. So I think they're probably entering into a very strong phase now. I think winter season, you probably got vacations, a lot more offers, international destinations. But somewhere I think when you probably look at numbers, either Indigo or Spicejet, I think the operating expenses, even with the acquisition of the jet fleet, I think that is still probably playing out in terms of balance sheet dynamics and not reflecting positively in terms of cash flows. So I think I'll still take my time for the aviation stocks, purely based on the operational dynamics that these companies are reporting.
Mayuresh, the stock of the last two sessions arguably has to be Glenmark, and it just shows that if you have a positive surprise in a beaten down space, in a beaten down stock, the rallies can continue. My question is, after this mammoth uptick of close to 22% in the last 2 days, or actually more than 22% in the last 2 days, is there more in store?
There is a possibility, Neeraj, and again, I think the estimations in terms of what was expected to come through and what they delivered, specifically in terms of the Indian domestic formulations business in excess of 15 odd percent. And again, I think the guidance in terms of the US business as well, higher single digits, I think that is a positive sign that is probably coming through. The second element that the street and would ideally now like to watch out for is 2-3 elements that will probably come out. A, in terms of their non-core divestments, what happens on that part and how does that help in deleveraging the balance sheet. The second element obviously is the demerger in terms of their core innovative businesses and what kind of a value unlock if and when that has to happen. And the third element obviously is the earnings outlook itself. So when you're probably looking at better numbers expected to come through, I think that was what was getting reflected in terms of the move that we witnessed over the past couple of days. So I think the next two steps in terms of trigger points, both from a valuation and earnings perspective, is obviously going to be the deleveraging of balance sheet through non-core asset sales, and obviously what goes through in terms of the listing of its innovative business as well. So I think that might be the next few triggers for the stock. But I think a large element or the large part of move has probably happened. Largely beaten down, undervalued. I think the stock aptly reacted to the numbers that they reported. But our top pick still remains Zipcar Labs within the pharma space.
Okay. Mayuresh, do you feel real estate has run its course? I mean, while at the start of the year was fine, we saw a lot of movement in most of the majors out here. But the last few months have been extremely dull.
No, again, Devin, I think it's trying to readjust in terms of both the numbers that they're probably reporting and the data points that are coming out of the sector as a whole. So I think we've time and again spoken that not all pockets within the country itself are conveniently placed. So I think a lot of inventory hanging around. You've probably got pricing related issues with new accounting norms that have probably come through. I think the cash flows remain far more positive, both in terms of revenue recognition for the existing projects or the liquidation of inventory, and whether they are able to launch any new projects as well. So I think very few developers have actually been able to launch new projects. So the sales velocity thereof from new projects and the existing projects being taken off, I think remains very, very few and distributed among very few pockets. Having said that, as Shrikant was also mentioning, I think Brigade did come out with a good set of numbers. I think the kind of base that it works out of, the kind of expectations that one has in terms of delivery, both in terms of executable area and the realizations thereof, I think that looks like a promising bet. But out of the real estate developers operating out of the West, I think Godrej Properties, again, I think there is some time in terms of price action, but the kind of numbers that they've kept on reporting and the balance sheet dynamics from a leverage perspective as well, with debt equity below 1, I think that's an encouraging sign. So I think I'll be very, very selective when it comes to real estate as well.
Okay, I'm just looking at the Morgan Stanley note on Grasim after the developments. This has come out this morning, I reckon, and it says that with the context of the uptick in pricing and otherwise, they believe that the market would tend to reward Grasim's stock price and narrow the holdco discount, which is currently at 56% versus the historical averages of 43% since 2011. In the event of any significant development, either positive or negative, where perceived capital allocation risk comes down. Now, this certainly means that the perceived capital allocation risk could come down. And therefore, my question to you, Mayuresh, is fundamentally, while everybody talks about whether it's a Bharti Airtel or a Vodafone or a Bharti Infratel, is there a tactical call to make an investment in Grasim?
No, I think I'll wait and watch, Neeraj, because I think you're not really sure in terms of what changes are going to take place. And when you look at the core business itself, I think VSF realizations are really looking muted at this point of time. When you're probably looking at the consolidated numbers as well and the sum of parts, I think Ultratech is doing fine. But when you're probably looking at the overall picture itself, I think I'll be better off looking at other cement companies at this point of time or other diversified plays. Grasim, no, not at this point.
So what are you looking at, Mayuresh, at this point in time? What kind of businesses are you interested in?
No, so I think we are actually adopting a stock-specific approach where I think the earnings have been pretty good. And even if the stock has run up quite a bit, our own sense is that if the earnings are expected to continue, I think the price earnings growth, I think the PEG ratio should work in its favor. Having said that, I think a stock like Nesco, for example, I think very good set of numbers in my opinion. If you probably look at their IT park business with Building 4 coming up, I think that's shown a very, very robust growth, and that got reflected in the overall top line moving 28 odd percent, EBITDA moving 25, 26 odd percent as well. From a balance sheet perspective, when you're probably talking about cash on balance sheet of 570 odd crores, even they were incurred capex of almost 500 crores in terms of building the new Building 4 for the IT park and the new exhibition centers, where the expectations is of a very strong pickup over the next 2 quarters, and their own division itself of Nesco Exhibitions, I think they're poised in for a very, very strong earnings growth. So positive cash flows, ROC is in excess of 21%, ROE is expected to touch 17.5%. I think that makes a very, very strong investment case, though the stock has run up quite significantly and valuations might be a tad bit high. But I think the price earnings growth would continue for a stock like Nesco.